The European Central Bank cuts interest rates again. Welcome to Market Insight. I'm Ramzan Karamali. Well, for a second straight meeting, the ECB cut rates by 25 basis points, meaning the deposit rate now stands at 3.25%. The widely anticipated move comes as inflation now stands below 2% and could settle around the central bank's target quicker than previously thought. Well, to give us more analysis on this rate cut, I'm joined by Hetal Mehta, Head of Economic Research at St James's Place. Hetal, thanks so much for joining us. So the bank gave no clues on its next move, but the markets are expecting similar cuts on each of its next three meetings. Is that what you're expecting too?
I think it's going to be quite difficult for any central bank to pre-commit in a time when the data is quite noisy and volatile. Even at the time of the last ECB meeting, they themselves didn't expect that they would be cornered into doing this kind of back-to-back move. So I think it's sensible that the ECB is not pre-committing. I think given the trajectory on economic sentiment and inflation, I'm not entirely surprised that markets are pricing in more. I think as we saw with Fed pricing, they've in some ways led us to believe that there would be a more front-loaded pace of easing. And yes, the ECB feels that it's appropriate for them to do that as well, but still keeping all options still on the table.
So do you think it's too optimistic to expect another three in a row?
I think it is on the basis of the inflation profile. The core inflation numbers are still closer to 3% than they are to the 2% target. Wages are still growing at a fairly decent pace. And so there's not enough evidence that that pull to 2% is happening rapidly. And I think the ECB is now just in a bit of a funk between slowing growth and obviously inflation still being a bit high. But I don't think that we should expect that path as necessarily appropriate given where underlying inflation still is.
You mentioned their wages. We've got a number of unions across Europe demanding bigger wage rises. So do you really think this could be quite a big impact on future decisions?
So the wage numbers are really key for most of the central banks, but the way wage rounds are set, generally annually in Europe in particular, and when you look at Germany, you get these kind of multi-year wage deals, so they can be quite lumpy. And the recent inflation memory that people have of higher headline inflation will still continue to feed into wage demand. So it will take a while for that shock to kind of run its course through the system. But I do think eventually wage growth will moderate, particularly if we did start seeing unemployment start edging higher.
Now, the ECB statement also talked about the disinflationary process being well on track, but it did highlight the downside surprises and indicators of economic activity. So this sort of economic weakness that it talks about, that's surely going to make an impact on the decisions going forward?
Yes, I think it will. But we also have to see how much of the China stimulus that's been announced managed to stem the downside risk to the manufacturing sector. And I think that's been a really key part of the weakness, again, in terms of German sentiment, and that's bringing down overall European sentiment. So if we can at least cap the downside risks in that sector, then I think that should help to keep things on an even keel. And we also had the bank lending survey out this week. So credit conditions in Europe are actually improving. We have higher credit availability, credit demand is up as well. So I actually think this downturn could be short-lived if the rest of the economy and the global economy carries on in this kind of soft landing zone as we expect it to.
Hetal, do you think the market's also getting a sense of a split between the hawks and the doves within the ECB Governing Council?
I mean, markets are always trying to find that gap between the two. Again, when data is so mixed, it's natural for central bankers to disagree. I think we'd be worried if the consensus was too strong. And we see that in other central banks as well. The Bank of England, for example, well known for having quite open vote splits. So I think markets will look for it, but we shouldn't be surprised if it's there.
Hetal Mehta from St James's Place, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.